Finance Advisory Committee meeting to order. We'd like to start by acknowledging that the land on which we live and work is the traditional territory of the Anishinaabe, the Haudenosaunee, and the Wendat peoples whose presence here continues to this day. Aurora is part of the treaty lands of the Mississaugas of the Credit and the Williams Treaties First Nations. We acknowledge and thank them for sharing this land with us. A shared understanding of how the rich cultural heritage that has existed for centuries and of how our collective past brought us to where we are today will help us walk together into a better future. Can I get a motion to approve the agenda? Michael, Harold, comments, questions? All those in favor? Opposed? That carries. Any declarations of pecuniary interest? Seeing none. Can I get a motion to receive the minutes from February 8, 2022? Michael, Harold, any comments, questions on minutes? Call a vote. All those in favor? Opposed? That carries. No delegations. We have 3 items. First item is memorandum from Financial Management Advisor regarding 2022 Prudent Investor Regime Review. Rachel.
All right, I'll also ask Jason to turn on this video for this because you guys might have a number of questions and he's been working on answers all day. Okay. So if you remember back before the pandemic started, we were exploring moving towards prudent investor as a way to earn better returns on our long-term investments. So these are monies that they consider not required immediately. So funds that we'd need at least 18 months or longer out. So particularly one of the big advantages is monies that we're setting aside for doing some of our water, wastewater infrastructure repairs that as you saw in the asset management plan, don't come at us until around the 2050s. So this helps protect us against inflation. So we're here back at Finance Advisory Committee. We've provided attachments which include the results from the JIB. The JIB was formed in 2020, less rich or founding members than what they anticipated. The pandemic did throw things for a loop a bit. But they did manage to get started and have been active since, I believe, summer of 2020 in investing municipal monies. This memo gives a bit of an outline as to, again, the types of returns that we can earn and what we can invest right now on the legal list, which is very limited, versus moving to the prudent investor where we actually have the expertise of experts in investment. So obviously with these types of investments, there does come a little bit more risk, but that's why we're focusing mostly on longer term investments. And over the longer term, you can mitigate much that risk. So I'd like to turn it over if you have any questions at this time, and Jason's well prepared to answer some of them.
Thank you, Rachel. Guys, before I ask for, I'll just ask for someone who wants to move the recommendation and second it, then I'll get the comments and questions, just the way I like to do things. So someone want to move the recommendation? Harold, second. Michael, thanks. Comments, questions?
Yeah, perhaps we can start on clarifying what is the recommendation or the action staff is looking for, because it's not clear in the recommendation. It's just asking us to receive and then whatever comments be for consideration. So I guess what I'm getting at is what's the staff recommendation here?
So what we're looking to do is we decided to come back again to FAC. We went to FAC a number of times back in 2019 and I think maybe early 2020. We reviewed the investment policy at that time. Not much has really changed, but we thought it was prudent to come back to FAC first before we then go back again to committee. So the next step would actually be going to committee again. So we wanted to give FAC another opportunity to take a look and review and see if we still have the support to move forward with potentially going to be a prudent investor.
Michael?
Okay.
Okay. Any other comments or questions?
So I guess, yes, through you to Mrs. Well, either to Jason or Rachel. So we never actually adopted the investment policy statement then because the motion was defeated at GC. Is that correct? So
Yeah.
then any future report would then put us back in that position where we're looking to again adopt, because I'm just going by the following steps on page 2 of 7. It says, you know, this is the steps we need to follow. 1 is the adoption of a policy statement. 2, the execution of a JIB agreement, and 3, obviously then the bylaw and so forth. But so none of those steps have obviously been adopted. That's where we're going to start. I guess my first question then to both of you really is, you know, timing. As we know, the markets have been tanking like crazy the last little while. And so on the surface, you know, the public's going to be saying, and I'm sure around council, is this the right time to be looking to be doing this? And I guess there's an argument both ways. One, you could say that, well, you know, our returns may be minimized as it is, so maybe it is a good time. But then at the same time, others would say, well, maybe it is higher risk given the current state of affairs. So is there any comments with regards to the timing of pursuing this given the current outlook that's going on in the stock markets today?
Yes.
Through you, Mr. Chair, in terms of timing, generally the a prudent thing is just to buy low and sell high. So right now market values are all dropping. Now's the time to actually buy into the market. But it also takes time to work through the steps that you outlined, Councillor. So it's going to take time to do this anyways, to work through all the steps that we need to work through. So by the time everything's said and done, maybe the market will be better. The other thing to note is when we do reach the stage of transitioning our funding over to the PIA, if we reach that stage, they take their investments as they exist today. So they don't force us to sell our investments immediately. They kind of just add them to the portfolio and move forward and slowly transition them into, you know, other investment opportunities. So we don't need to, for example, sell when the market is lower existing investments. We can carry them over with us to that portfolio. We won't have to take a loss in that regard.
Michael?
Thank you. Then my other question really is just perhaps we can just walk through table 4, because how you calculate the difference didn't necessarily make sense to me, and maybe I'm missing the obvious. But you know, I guess I was looking at it from the difference between the position on July 2nd to the December 31st position, and the balance number in dollars didn't necessarily reflect the difference in the balance between those two dates. And so perhaps, so for example, you take global bond, the balance was 113 million, I guess on July 2nd. On December 31st, it says 118 million, but it says the balance is 0.5. So and the same with Canadian equity and global equity. So am I missing something? Perhaps you could walk through how the calculation was, or to me, I was just looking at the straight adding and subtraction.
Jason?
I unfortunately did not digest this table. Is it possible for us to get back to you on this one?
Yeah, for sure. But would you agree that it looks off?
Well, it does seem a little bit off.
Okay.
Yeah, and Michael, I would say it's just those last 3, but the price one is correct, right? But this, yeah, you're right, it's the balance number that seems off on those 3.
Yes.
Yeah. It's like the decimal point is in the wrong spot or something.
Yes and no. I mean, global equity, it looks like, you know, the difference is, you know, 5 and change. But yeah, they're just, whether it's just the decimal point or there's something more to it, I'm happy for you to take a look at it and either update it or send around the corrected version. That's fine. And then I guess the other one, just to clarify table 5. So when we're talking basis points charged, these are decimal basis points. This isn't 35%, 40%, 45%. This is 0.45. So perhaps maybe just some clarity around that, just so, you know, if people aren't too familiar with that, it becomes a little clearer. That's it. Those are my comments.
Thank you, Michael. Carol?
Thanks. If I recall, the reason why this was declined in the last committee meeting a couple of years ago, there were 2 items two big items that staff, or really the one representatives, when they came for Q&A, weren't adequately able to respond to. One was liquidity and the other was the fees. So if I could start with the fees first. Now in the annual reports, it talks about Canadian Equity Fund dropped its, they were happy to report that they're going to drop their fees from 60 beeps to 50, and the HISA from 7.5 to 3.5 beeps. So that's great. But then when you go into the staff report, it's a little bit watered down, and I'm not quite sure exactly what the municipality is being charged. Where was I reading here? So if you go to the bottom of page 6 of 7, under legal list investments, says, although the town does not pay separate management fees, the investment brokers through which the town accesses legal list investments receive their compensation through the difference between the wholesale rate offered by the banks and credit unions and the institutional rates that are offered by the town by the investment brokers. So I'm not quite certain exactly at the end what the town is paying overall. And then on the next page, page 7 on the top, it says, as a not-for-profit entity, the one investment structures fees so as to recover its operating costs and set aside appropriate reserves for future investment. Neither one JIB nor one investment will charge fees directly to a participating municipality. So we're not being directly charged any fees. Like normally to clients, whether institutional or retail, money managers will say, we'll charge you 100 basis points or 75 beeps or something of that nature. But in this report, it says we're not being charged. It's just to recover costs. But then in the annual report, each fund has a cost to them. And so I'm just kind of, Jason or Rachel, if you guys can kind of confirm exactly what we're paying.
Jason?
Through you, Mr. Chair, did you want to go, Rachel? Did you want to respond?
Okay, I'll take part of that. So for the comment about not being charged directly to the participating municipality, it means that we're not paying like an annual fee or something that we get billed directly. So this is all part of the overall management of the entire fund. They are a nonprofit, so the more people that join the JIB, and there has actually recently, I believe another municipality did join the JIB, the more municipalities and the more funds they manage, the lower the overall cost is per the amount of dollars that are invested. So ideally it should decrease over time as more municipalities join the JIB. Jason, did you want to add to that?
Through you, Mr. Chair, the only thing I was going to add to that, along similar lines to what Rachel was saying, yeah, the fees aren't billed directly to each individual municipality, but the entire portfolio is billed these fees. And so indirectly, each municipality is paying the fees. They're not being paid directly in terms of the fees. So there are fees involved, as Rachel said. The fact that it's a nonprofit, it keeps the fees lower. So they're just trying to cover their costs. In regards to the fees we presently pay for our legal list investments as a town, though that's not, it doesn't appear to be abundantly clear because they kind of bury it in the price they give us for the securities that we're purchasing. So we could try reaching out to, I believe in the past we had a similar question. We did reach out to the brokers. We're not very forthright in terms of the fees that they're building into the price they give us in terms of the investment purchase price. But we could ask the question again to a couple of our brokers. We have multiple brokers. We could ask the question and see if they will disclose at least an average fee they put in there I suspect the margins can't be too high in regards to institutional type rates that they're offering, but we could try to get some more clarity there.
Yeah, thank you. And when the public and the public regulators are going so far as to, they're putting in, regulations to be biased towards clients, especially when it comes to fees, and making it clear and transparent so people know what they're buying. It just doesn't make sense for us at a municipal level, and we're supposed to be prudent investors. It seems kind of a paradox when it's not clear exactly what we're paying. I suspect that it's a reasonable amount, but I think it's fair for council and all, the public residents to know what that number is. And I don't understand why there's this vagueness in terms of, the variance between the broker dealers versus another broker. Like, it just seems like watered down. So there should be no reason why they can't give us a one encompassing fee, regardless of whether, the town of Muskoka or Whitby have 10% of the assets under management or 1%. It shouldn't impact, the management expense ratio. It should still be the same for all, prudent investors or municipalities. So if we go back to committee again with the same response, it's never going to get passed. And that was a big one. So if you can go hard on them and just say, we need a number, and it should be in a public document, whether it's a fund fact sheet, because that's what the public regulators are forcing all fund companies to deliver, is a fact sheet that has all the relevant details. And we have to dig through annual reports, several documents to uncover these numbers. It doesn't seem right. So if you can figure that number before it comes to committee, that'd be great. And the other big item was liquidity, and I believe council inquired, what if some extraordinary event happened in the town and we needed to liquidate most or all of our assets? And it wasn't clear at that time how that could happen or if that could happen. So what is the liquidity or redemption frequencies that were allowed? Because I know staff responded that, based on, our short-term needs, midterm and long-term, we'll only set aside funds for long-term investment, those funds that we won't be needing in the short term. And, we get that, but there's always going to be someone that's going to be asking, if the world falls down or the sky collapses, we need to redeem. Is that doable? And that answer was not forthcoming. So is there an answer for that, Jason? Well, is there usually, if you're investing in an illiquid security, what they'll do is put in a declining redemption fee or redemption charge or something of that nature if you're in like a infrastructure or private equity investment. But these are just simple global and Canadian bond funds. So can you guys respond to what the redemption features are for us?
Through you, Mr. Chair, what I have learned is generally once a year there's a process where each member of the one JIB is given an opportunity to firstly identify new funds to go in or funds that need to come out. So there's a regular process that's done once a year. However, once that date has come and gone, there is an opportunity throughout the year to contribute additional funds to the JIB, as well as redeem funds or remove funds from the JIB up to a maximum of 25% of what you have in the JIB on your anniversary date. So if we have $100,000 in the JIB, we can take $25,000 out at any time over the course of the year. That's my understanding in terms of the liquidity kind of clauses around the JIB. I think it partially has to do with these large parts of it is long-term in nature. There are short-term parts of it as well. They've rolled into the portfolio a series of existing products, which are short-term in nature, and they added the two longer-term products that are the global bonds and global equity. Two investment vehicles you can't access outside the PI standard. So we'd have to investigate whether that 25% rule applies to the short-term part of it. I suspect no, but we would have to confirm that. But generally speaking, the number I've seen a few times is 25% can be pulled out at any given point in time. If we need to pull more than 25%, it might depend on the duration of the investment, whether it's short-term or long-term in nature.
Carol?
Okay, thanks. And I think one thing that came to mind was that I think the people at One Investment or staff mentioned that, if at the early stages, when we were going to be one of the original JIB members, the response was that, if we're one of the original JIB members and there's only 200 million or 300 million in there, taking all our money out or liquidating half, it would potentially impact the overall fee and the trading fees and so forth, because the scale is not there. I would imagine, 2 years later, there's a lot more assets in there and the original JIB members feel a lot more comfortable. So I suspect that that's changed a little bit, at least. But yes, Jason, if you could confirm, that 25%, whether that's, the frequency and whether that's the maximum, so that council has all of that information before they make a decision, that'd be great. Thank you.
Thanks, sir. Michael, again?
Yeah, thank you. I think with regards to, costs, I think the financial statements that are included within this report provide some transparency, I think. You look at their statements for 2019 and 2020, it kind of gives you a sense of what the cost is for them to run the program. And, when they say they're not for profit, well, it's kind of set up in the sense that, out of the money, they pay for all their expenditures, and whatever is left over at the end of the day, that's the return on the investment. And so, for 2019, their total expenditures were $2.5 million. So that's the management fees that they charge to cover all of their costs. And in 2020, it's $3.9 million. And so I think too, if possible, what may be helpful as well is if, when this comes to GC, if their 2021 statements are available, perhaps we can add that as well. I think my only concern really is, is there substantial increases in the expenditures of this program? We see go from, like I said, 2.5 to 3.9. As more money gets invested, they bring on more people. Is there some sort of cap? But perhaps this can help explain that process about what the real costs are in terms of, those questions that council was asking us. It does provide some insights into salaries and expenditures and so forth through the financial statements. And if their goal is say, hey, listen, we got more than enough people on board, and no matter how much more money comes in, it's only going to end at the end of the day, decrease that expenditures to revenue perspective. And so it's going to cost everybody less going forward, then that's great. That's a good message to share. But it looked like their 2020 statements were ready in June 2021. So who knows, maybe their next ones are as well. But I think that would help to some degree with the comments around what's this program cost, how is it structured, how is it run, how are the fees are. But looking at it, that kind of helps me to explain for myself how they set them up as a nonprofit, because they essentially, they take money off the top and the rest is the return, and that's how it's factored in. So I'm still supportive overall of us continuing to go forward in this direction, but I think that it's good that the more transparency, the more of these kind of pieces that we can provide to council and to the public, it helps give some assurance and answers all of those questions that may or may not be up there still. That's it.
Thank you. Any other comments, questions?
Actually, one request, given, as Michael mentioned, the market hasn't been very accommodating or constructive the last couple of months. And I would imagine that this is still going to be in people's memories, even if markets turn around tomorrow. And so, if you guys can provide a performance track record beyond, let's say back to 2006 or 5, so that when people see, people remember 08, 09 and the great financial crisis, how the markets dipped, but they did come back. So for people with short-term memories and are concerned about putting public funds into an equity fund, we should put in a reminder that, hey, catastrophe did happen in 08, 09, but over time they did come back. So, if you could have a track record for all those, the bond funds and the equity funds going back that far, I think that would go a long ways in kind of building a little bit more confidence among those who are not, who are more risk averse.
Thanks, Al. Call the vote. All those in favor? Opposed? That carries. Next, we have memorandum from manager financial management regarding Counterwear debt management update. Rachel?
Yeah. So through you, Mr. Chair, recently at General Committee and Council, we've heard a lot of comments about debt and a little bit of confusion by some members of Council as to how much debt is actually outstanding, what type of debt we have. So we thought we would put this together just to give an overview so that it's there for FAC, and we'll end up on the Council minutes just to put a record together of what the debt is that the town currently has outstanding. So on page 2, it gives a summary of the different types of debt we have. So we have short-term and long-term debt. Our short-term debt is mostly made up of construction line of credit. So these are lines of credit that are available to us until substantial completion of a project. So we have some for Aurora Town Square, which we have begun to draw on and are using. And the other one is for the Sark Gymnasium, but we haven't even gotten into figuring out the construction for that. So obviously we have not drawn anything on that at this time as of yet. Both of these ones, they do get to substantial completion, will have to be converted. The Aurora Town Square, we can convert to long-term debenture, or we can convert to capital loan for 5 years and then long-term. It depends on, the market rates at that time, where we're at, and what we're looking at to decide when we should move. Jason and I are already having many conversations about and debates about when the best time to do that may be. So we're putting together a bit of analysis on the Aurora Town Square piece for sure, just to understand what the impacts are, different rates we're seeing, and different things we're hearing in the market. Our long-term financing includes a number of projects that have already been completed. We have some of the more recent debt that we've issued for the Hallmark baseball diamonds. That is paid for through Parks and Recreation development charges. So those are future development charges that we'll be receiving. And the Sark construction, which actually ends in 2025. So that one's coming to a close, and that's also paid through DCs. The Aurora Sports Dome was a recent one. We are using the annual operating revenues that we're gathering through user fees to pay down that debt. And then we also have the streetlight conversion project, which is coming to a close in 2026, which isn't too far away as well. So that is pretty good. And then we also have the GOC, which is also related to Parks and Recreation development charges too. So there are a number of things that are pulling on the Parks and Recreation development charges. So we just have to be mindful of that as we go forward. That is why we also included a little bit of an analysis on the status of the Parks and Recreation development charge, just only that specific service, not the development charges as a whole, as to what it's looking like over the next 10 years based on the budget. So as you can see in figure 1, the balance does end up decreasing over time, but there is an opportunity to take a look at what we're doing with the projects that are in there, the timing of those projects, and also how growth is changing and may adapt. Over the last couple of years, our development charge collections have been low. So that is also having an impact. And the forecast is includes development charges, but not to the level that's included in the DC study. It's a fairly conservative revenue forecast for this service. So that's going to be a focus that we'll have as we go forward to future budgets. But what we do have current debt for is definitely sustainable. It's just how we'll handle it going forward in the future. We are also planning on coming to FAC next month in June. We are working through developing a debt policy, which will look at the annual repayment limit that we have for debt, and which is 25% of own source revenues, which includes most things except development charges. But it's still a significantly huge amount of money. And we're looking at putting an Aurora target at a much lower amount, which is still, and we'd still be well below that target. So we'll be coming back to FAC in June to get support and comments on that before we go to GC and council on it too. But this just gives you an overview of what debt we currently have out there.
Thanks, Robin. Rachel. Sorry. I guess, and I know Michael's going to ask a question, but before I get to Michael, I just wanted to clarify. I'm assuming this report was for our last meeting, correct? Because at the end, it states that this is going to be coming. It's going to be, the policy is going to be coming for feedback May 10th, and then going to council in June. So I'm assuming now it's June. Do you know? Is it going to be in July or in August when it's going to go to council? Or
it'll likely be July at the earliest.
Okay. Thank you, Michael. Go ahead.
Thank you. I actually think it's great to have these two reports, the previous one with regards to our investment strategy, and then this one with regards to debt, because I think they're intertwined, and this is part of the reason why they get, let's say, confused when we're discussing it at council, because there's strategies that underlay both of them. And I think that, if you bring a report like this forward, I think it's also good for you to be able to identify what the interest rate we're paying on the various, debentures and financial components are, because, when some speak of debt, they just think, debt's bad, we shouldn't be in debt. But sometimes we choose to pursue debt financing because it's a better option for us, and it really goes around the rate of return. And so, as we saw in the previous report, when we were talking about our investment strategies, and whether it be the legalist or moving forward to the prudent regime, you've seen the rate of return. And for the most part, it's always been my understanding that the rate of return that we are earning on the money that we invest is greater than the rate being charged to finance through Infrastructure Ontario or whatever venture that we're utilizing. And so, to me, that's good money management. If I can earn 4% on my money and only be charged 2% on the money I'm borrowing, well, there's a net difference of 2%, and that's good. And I think that's why these two reports are good together, because they help solve that problem. Because the reality is, if you look at our schedule of reserves, I think we have $100 million roughly, if you add all of the components together, somewhere around that, or correct me if I'm wrong, you guys probably know the number better than I do, but we certainly have significant funds that we could choose to internally fund all of these things, or some of these things, rather than pursue those other vehicles. But again, it comes down to a conscious choice of what's the best way to manage the money for the organization. And so I think that, that's the point that needs to continue to be hammered home. Anytime we're talking about debt, there's a choice we make, and we're making it based on financial or fiscal policy or, principles that, listen, in this particular case, we decided to go this route because rather than utilize our own money or internally finance it through our own reserves accounts, it's better to pursue it this way because we make more than we're paying. And to me, that's always the underpinning argument, but it never really gets fleshed out well enough in our conversations, because, people just assume that debt is bad for the municipality. But we know that, you look at the BMA studies, and, Aurora is well positioned compared to many, many other municipalities and others in terms of our ratios. We also know that, our reserves are quite healthy, and we are in a good financial position. So, some may look at, oh, geez, our total debt obligation is $27 million. Oh my God, what are we doing? But the reality is we have more than enough money to cover that if we were so to choose. But we've gone through these vehicles for a reason, and the reason is that we make more than it costs us to borrow. And to simplify the answer, and it's more complicated than that, and you guys can explain it all. But I think if you can, I would bring the two reports together so that they kind of show people that are interested in this, that listen, here's how well we do from an investment side, and this is why we choose to pursue these kind of vehicles from a debt perspective. And if we can have historic returns on average that are always greater than whatever we forecast as the rate, then great. Now, I don't know in this current climate with regards to these financial implications, whether the rates that we are being charged on these financing debentures and so forth are variable or fixed or not, but that may be part of the conversation too. And how does this look with the rise of inflation, in which case I'm sure that we have a strategy to deal with all of those aspects of it. But it's always been my view that debt isn't a negative thing. It's just a decision that we make to pursue. And I'm always conscious of whatever, be it our fiscal strategy or whatever report we're going to. I never want to put out the message to the public that it's a terrible thing to go into debt. Right? It's a decision that you make based on, to me, math. It's simple. You look at the numbers and you figure out this is the best way to go. Now, some may have a principled approach, or they're just opposed to it under any circumstances, and so be it. That's their choice. But for me, I look at the numbers and the math and say, okay, it's better to do A than B, and then I'm comfortable with it. And so, I'm okay with the report. I think it's just if you can include some information in terms of giving some numbers around what we're paying to service this debt versus what we make on our investments, I think that helps explains the situations in plain terms, right? No different than I can take money out of my account and go buy a car tomorrow, but if I can get 0% financing to buy a car, why would I? If I'm earning money on my investments, right? So I think that equates it into layman's terms. That's it for me.
Thanks, Michael. Well said. Harold?
Yeah, I mean, I think my comments are along the same lines, as in that every time we talk about financial reports, there's always some around the table who will just focus on one aspect of the report, which is often the negative side of the report or perceived negative. And so if we know what the report really means, I would hope that staff will put that messaging in there. For instance, on page 2, it says an analysis, the town's current debt obligation remains in a healthy position. But when I read everything else, it spells that we're kind of under a little bit of financial stress. Like on page 3 under Parks and Rec development charges, historically, most of the town's debt financed projects have related to the construction of new indoor and outdoor rec facilities. This debt's primary repayment funding source is Parks and Rec DCs. A couple sentences down, it says, since this funding source has and continues to be heavily used, its use must be closely managed. So I know, for me, that kind of raised an eyebrow, and I'm sure to others it would. And when you look at figure 1 with the histogram, many will just focus on the green section, which is below 0, and just talk more about the debt. So is there any way, Rachel and Jason, that before this comes to council, that you can kind of reinforce that if staff believes that we remain in a healthy position, that we kind of put in some more comments or supportive comments to that end?
Rachel?
Through you, Mr. Chair. So what our plan is, when we go to council, we plan to bring the actual debt policy itself. This is more just information for FAC, so that there's the information on our debt is out there. The big difference, particularly with one as we move forward, is we have a number of significant projects, growth projects, that are sitting in our future capital projects. So these are projects that haven't even started yet. And it's going to be a matter of the timing of those projects, when we start those projects. And some of them, like there's one large one in particular, we may have to say, okay, well, if we really want to do this, unless development charges start to pick up, then maybe we need to get grants to help us pay for it. So it's going to be some of those type decisions that will need to happen. The key thing is it just needs to be managed well. So before we enter into approving significantly large projects like new facilities, we need to be mindful of what that future debt obligation looks like, what the future revenues are. And that's a lot of what the policy gets into as well. It sets some policy around minimum development charge balances, maximum ARL that we want to stay within as a town below what the provincial set is. And the other thing to keep in mind is as a municipality, we can only issue debt for capital assets. So we actually have to have a physical asset, just like you would like if you're having a mortgage, and we have to pay off our debt. So whereas the provincial and federal government, they operate under very different rules.
For sure.
Harold?
No, that's it for me.
Yeah. I want to, I mean, two of you pretty much said it, and I think we've had this conversation, but is it possible to kind of maybe add an example line similar to what, like, kind of what Michael was kind of like saying, if we took this money, this is right now, and we took it from here, this is how much we're making as a percentage, you know, in interest. And if we get the, you know, go into debt for this amount, this is how much we're paying. So therefore, this is, you know, basically that simple math that Michael's talking about, to actually show an example. It doesn't have to be a real life example. It could just be an example, right? Just to give everyone, so they have maybe a better understanding of how it works. Because I think, you know, as was mentioned, I think when everyone thinks debt, they automatically assume like your credit card where you're paying like 18% on it, right? And they think that, oh, wow, you don't want to be doing that. And they think it's such a bad thing. So I think that if we show them that mathematical example of where we end up actually financially ahead, I think people get a better understanding. So that'd be my only comment. Thank you. So someone want to put the recommendation, which is?
I got another comment.
Oh, yeah, sorry, Michael, I thought the hand was still up. Go ahead.
I just want to follow up on Harold's comment about the histogram on the figure 1 with regards to the DCs for Parks and Rec. And the comment that, you know, part of the reason why it looks like this is these future projects that are in the 10-year capital plan, which, you know, aren't necessarily approved, but they're there. And I guess, you know, is there value in saying, okay, if we didn't approve another project, another big project going forward, how long would it take for this reserve account to right size itself and be on the positive side? You know, would it be out of the negative by 2031 if we didn't add those new projects that at this point are placeholders? There's no real approvals in place, right? Just to give people a sense of, you know, what the timelines are. Is it 5 years, 10 years, 20 years? I'm not sure, even for myself, to think about, you know, what the impact is given whatever we're forecasting as DCs coming in. You know, no different than sometimes, yeah, to the illustration or the example of using a credit card. You know, you get your credit card bill and says, well, if you make the minimum payment, it'll be paid off in 20 years or whatever it is. Well, if we didn't add any new projects that drew from the Parks and Rec development charges, when would this account be positive?
Rachel?
So through you, Mr. Chair, I don't have the numbers in front of me, but I have seen them recently, and I think it's in and around 2028, 2029, somewhere in that time frame, that if we pull out one major project, we get back to positive balance in this reserve. And again, that's all about managing the capital plan and capital planning. So, and just making sure that we're operating within financially sustainable means.
But that's a relevant piece of information. I mean, to Harold's point, I mean, when you look at the chart and you see the green growing, you know, exponentially, you think to yourself, geez. But if you're saying, well, listen, this is partly due because of this one particular project that's on the books, but certainly nobody is, we may need it, but nobody's formally approved it. If you didn't have this one project, we would be on the plus side by 2028, 29, 2030. You know, I think that does, you know, paint a different picture a little bit. So it's good information to think about. That's it.
Thank you. Okay, so does someone want to move the recommendation? Michael, Harold? All those in favor? Opposed, that carries. Next, we have memorandum from Project Management Office regarding town's major capital projects update. Rachel.
Okay, I'm going to put my Doug hat on and speak to the major capital projects. I will say the one I know about the most is the last one, but we'll give it a try here. So the first one is a bit of an update on Aurora Town Square. As you can see, there is some information about the project schedule. It did indicate that we were expected to have the library turned over at the end of April. There are some delays relating to material sourcing due to COVID. We're waiting for an updated schedule and expecting the library to turn over in the next few weeks. So there is more information coming out of that with that. So there'll be a bit of an update on that timeline as we go. There are some challenges right now, as you may have heard today in the news. There is the I believe the Carpenter Strike that is happening. So we're monitoring that closely to see if that's going to have any impacts on the overall project as well. At this time, the substantial completion is forecasted for winter 2023 and completion in spring 2023. The budget status is in yellow status. We're not saying that it's going to go over at this time, but we are saying that there is some risk. The biggest risk is material shortages and changes resulting from COVID-19. It is a bit of a challenge, particularly in the construction industry at this time. So we are managing it closely, and we're also making sure we manage the contingency appropriately to hopefully be able to stay within budget on this project. The fire hall. So the work on the fire hall is progressing nicely. I'm sure if you pass by, you see that there's a fire hall definitely starting to take shape. And I believe the board should be coming down sometime soon. So we're looking for when that happens. The project schedule is showing that we're expected completion for occupancy in May 24th, substantial performance at the end of the month, and total completion in June 15th. And that should not delay anything from fire's perspective, being able to do their hiring and take control of the facility. At this time, we are still expecting to stay within the budget, and that's where we're at so far with that one. Joint Operations Center, additional work. So most of the work is actually complete. There's still work happening relating to entry pylon exterior signs, and that's part of a facilities project. And then also the storage buildings is currently in progress. The financial system. So this one's a really exciting one. We are in the midst of finalizing the contract, which we may have signed this week or next. And our plan is to actually get started next month. So we are well on our way with this project. We are forecasting right now expected completion. We did have a Q4 2023, but we may think it might be a little bit sooner once we do get started with our consultant. First thing we'll be sitting down is going through the detailed project breakdown. During the actual procurement, they projected about an 8 to 10 month implementation cycle. So it may take us less time and may be done before next summer. So more news to come on that one. This report was actually written before the council approval happened to increase the budget. So the budget is out of date. So it is now close to 2.5 million. And our plan is to be on or below budget for the implementation of the financial system.
Okay. Any comments, questions on the update? Michael?
Okay, so I'll start with the town hall, just really 3. So first off, the comment about the Carpenter Strike. I did reach out to Doug when I first saw that in the news, and our conversation was that it was primarily focused on residential. Do we feel that it's going to be expanded to include commercial, or do we feel that it's a ripple effect whereby, you know, because it holds up residential all of a sudden, supply and demand, and it'll impact commercial, you know, or institutional buildings?
Rachel?
Through you, Mr. Chair. So I heard from Robin today. She's not exactly sure how this is going to impact. So she's monitoring it fairly closely to see if there is going to be an impact, but it's pretty emerging news. So we're just waiting to see how things from our perspective will be impacted for the Aurora Town Square.
Okay.
Yep.
My next one really has to do with the breakdown of the budget and what's been committed to date with respect to the consultant fees. So already at this point, we're $22,000 over budget for the consultant fees. And we don't feel that that's going to change anything between now and I guess May 2023 when it's completed. So is there any explanation to why we're $22,000 over the budget for consultant fees? And are we really that confident that that number is not going to increase between now and May 2023?
Rachel?
Through you, Mr. Chair. So we will reach out to the project team and we'll get an answer and have that sent back to you guys. I do know that any of the overages, they are planning on using some of the management contingency to pay for that piece. So they've taken the offset out of there and that's shown on the table.
Yeah, I guess in this case, though, where I understand it from a construction perspective, I'd like to understand it better from a consultant perspective. To me, that's two different things. And then my final question is just, you mentioned briefly, it does say in the report that the targeted turnover date for the library remains April 29th, which is now passed. And so, sorry, I know you said there might be material shortages affecting that, but is there any new date or we're still waiting for that?
We're still waiting for the actual date, but we're expecting it to be within the next few weeks. Yeah. The actual date for turn handover.
Yeah. Like we've heard end of May is kind of what we're looking at, I think.
And I guess it's a question I sent to Doug, but I guess I'll throw it out here since we're talking about the new station. So, you know, JCC approved the new station and the picture that was of the new station. I noticed that now they have a new paint job and it really does stand out. You can see it from miles away with the big red and white everywhere. And so I guess my question really was to Doug, and I don't remember coming to JCC. So who approved the new paint job?
Does anyone know, Rachel?
Because, you know, you would have think they would have stuck to that picture. Now I know why they want to take that board down so quickly.
So maybe we need to ask Chief Lang.
You know how we kind of talk about new development being compatible and suitable and kind of fitting in with the neighborhood?
They wanted to match the trucks, I guess.
Very much so. Very much so. All right. That's it.
That's it. Harold?
Yeah, you know, oddly enough, the only question I have is on the JOC, additional work. So how are we doing? I know it's only been initiated, I don't know, a couple months or a few months. How are we doing from a budgetary perspective? So we committed 1.4 million. Are we confident that we're going to stay in budget so far?
Rachel?
So I do not have the exact details on this, but the committee will show anything we've got a purchase order issued against. So it will depend on the timing of and the work that needs to be done. So we can see here, the comment is that the borehole investigation is underway. So at this point in time, we would not have gotten to the point where we've determined what the overall construction cost would be.
Harold?
Okay. I guess the 13 sub-projects are each of the items on the table. But is it still one general contractor that's handling all of these?
Rachel?
Jason, do you know?
Through you, Mr. Chair, it's multiple contractors. It's multiple contracts. It's not one single general contractor.
Okay. Yeah, I'm just the more contract or general contractors involved, I fear that the greater probability that the project might miss the mark from a budgetary perspective. Hence the question. But yeah, I don't have any other questions.
Someone like to move to receive for information? Harold, Michael? All those in favor? Opposed, that carries. Any new business? Nope. Okay. Motion to adjourn? Harold, Michael?